Alright guys, welcome to our first video here on the Interbank Speculators channel. Today we'll be talking about entry types, and we'll just get right into it because we don't like time wasting. We don't want to ramble and rant a lot in these videos, we just want to get straight to the point. So without any further ado, we have risk entries and we have confirmation entries. You can read the pros and cons for yourself here. I'm not going to list that out or actually read it out loud. So fundamentally, if you narrow it down, you have two types of entries, and it's a risk entry and a confirmation entry. And with a risk entry, you're, as it says, you're risking your equity on a move that's not guaranteed. A move is never really guaranteed, but with a confirmation entry, you just wait for that confirmation. And with risk entry, you're anticipating it rather to form. With confirmation entries, you're also anticipating something to form, but it's at a later stage of the move. So usually you sacrifice a part of the move to wait for the confirmation, and that's why this is a lot safer, because you're basically waiting for the move to already have formed and then get in at the last part, right? Risk entries are quite nice if you get it right, but if you get it wrong, it's psychologically very hard on you, because you'll just see price ram through your stop loss. Risk entries, they're also known as turtle soups. Most of the time you're waiting for an SMR, either a time frame lower or on the same time frame, to form, and you're expecting that to form at a PD array. So let's just say this is the 1 hour time frame, and we now enter here a daily PD array. You just set a limit on the daily PD array on the open of let's say an order block, your stop loss below that, and you're anticipating a smart money reversal to form at that daily PD array. Usually you have like an original constellation before that, so it sweeps that as well. So let's say we have this original constellation and we move it down there, we sweep that before we trade into the daily discount array, and then we move away. Well, if you have your entry here and you sweep liquidity into a daily PD array, it looks really fancy, especially when you go into the lower time frame. You can say, you know, I caught the bottom here, I'm such a good trader, I knew it was going to move here. But it's really nothing fancy, it's just straight entering at higher time frame PD arrays, or maybe even below them when you're anticipating liquidity run and you're waiting for retracement. But this is not very special, right? Everybody can do this, but it's just a lot more risky. And if you're right, this is a really nice way of trading, because it's really, you wait for it to turn around, and once the price has turned around your entry point and you know you're right, you can go to break even fairly quick, and you can get to ride that whole move up, right? Which is also very nice. But the chances of selecting the best daily discount array where it's going to move off, they're there, and yes, they can be done with extremely high accuracy, but these can be also mentally draining if you have a few losers where prices ram through your stop loss, right? An example of a trade from a turtle soup could be like something like this, where you have your market maker model and you have the sell side of the curve here. You form an SMR around your entry, and your entry is already there before the SMR forms. So just you're anticipating and expecting it to form there. And usually there's some form of liquidity right below or above the daily discount array, so it looks really fancy, right? Another risk entry could be something like this, where you're not entering at the smart money reversal, but you are entering at another PD array without confirmation with liquidity before. So let's say you have your first stage of accumulation here by the ICT market maker model, and let's say this is a 1 hour order block, and we have liquidity right around equilibrium. We sweep that into a 1 hour order block in the market maker buy model, and you just set a limit at that order block. That's a risk entry, and it's a turtle soup, but it's a safer way for these risk entries, right? And an example of an entry would be something like this. You have your premium and discount of the dealing range. You wait for the liquidity at equilibrium to be swept, entry at the open of the order block, stop loss below, and you ride the whole move up until the original consolidation has been violated. Then we have confirmation entries, and this is just really a 2022 model with a breaker or your first or second stage of distribution or accumulation entry. We'll get into some chart examples, so no worries, we'll get into that, but yeah, let's get into the breaker first. This is a good confirmation for the breaker. It's essentially the same as here. You can either wait for confirmation on the first stage of accumulation, second stage, or you can even do it at the SMR of a higher time frame move. It doesn't really matter as long as there's a breaker there. It's considered a 2022 type model, and it has sweep liquidity, of course. But breakers with fair value gaps are usually the strongest, but because these entries are usually done within the first part of the move, you can expect some manipulation as well, so you have to be very precise when you're entering this. A confirmation entry with a breaker could look like something like this. Here again you have your market maker buy model. You trade into the 1 hour order block and you wait for the break to form. So we break market structure to the upside there. It's a shift in market structure. You have your breaker and you have your fair value gap right there in discount, and you can just set your entry at the top of the breaker and your stop loss below the low. And usually if this sweeps some sort of liquidity, this will offset accumulation or distribution, so the move will be very quick and swift away from the breaker. If it's gonna stall right there, that's usually not a good sign. Then we have confirmation entries for the second stage of accumulation or distribution. This is basically the second entry you will get after the breaker. So within the first example we saw here the breaker within the 15-minute FVG. So right now we're going to enter at these stages right there at the blue blocks of the market maker buy model, and you have your first stage, which is right there. We break out of that and we're expecting a retracement for the second stage of accumulation. You can wait for price to return back into a discount and into an order block, and you basically just ride the move from there. I really like these types of entries because you're very close to the draw on liquidity, so the move will be very quick without a lot of manipulation. So usually this will deliver quite fast. That's why people will call this a silver bullet, because it's basically the last stage before you hit the draw on liquidity. That's why it's really fast. And the reason why this is a confirmation entry, not a risk entry, is because we wait on the 1 hour for the 15-minute time frame to do this, or 5 minutes. So if we go back to the daily time frame, let's say we had a daily discount array, then we wait for the 1 hour to shift structure, so something like here. Let's say we're waiting for the 1 hour to be in first stage of accumulation here. So we hit a daily PD array, 1 hour is in the first stage of accumulation, we return into an order block, and then we wait for another first stage of accumulation on the 5 or 15-minute time frame. So yes, you could see this as a risk entry, but it's within context within the 1 hour and in the daily. So that's why it's really discretionary to say something's a risk entry or a confirmation entry. But in essence, these are all the types of entries you're going to get. You're either going to get a breaker entry, you're either going to get a turtle soup where you're expecting a move to form, or you're going to get an entry in the first or second stage of accumulation or distribution. Now, if we look at some chart examples, this is, I believe, USD Canadian dollar, and this is the daily time frame, and we're seeing bearish order flow right there. We're studying the part of a move here, so yes, this is hindsight, but this is really informational, so take notes. We're trading into a fair value gap and we're seeing bearish order flow, so we're expecting this fair value gap to hold. This is the daily time frame. Now we go back into the 5-minute time frame, and we're going to go into the 1 hour as well, but I want you to see what this looks like on a 5-minute time frame. So we're entering the daily premium array, and if we go into to the 5-minute time frame, this red line here, this is the low of this daily fair value gap. You can really see the market maker model here. This is your original consolidation. This is your first stage of accumulation towards the buy side of the curve. Then within the daily fair value gap, you get your smart money reversal, and this will be your low risk sell. And now we start to accumulate within a fair value gap after the low risk sell. So this will be the first stage of distribution in my eyes. Then we displace further down and we retrace once more, where we accumulate more to distribute down. So this is your second stage, right? I can reveal this part of the move is not in the time zone, not in the kill zone, so this is not really something you want to trade, but this still is a market maker sell model. Ideally, what we do, we'll get into a time frame cheat sheet, but what I do, I usually wait for the 1 hour to confirm from the daily premium array that indeed there is a market maker sell model. So I usually wait for the 1 hour to shift structure, which happens here. So what do we have now? We have a 1 hour shift in structure within this daily fair value gap. Here you can see the daily fair value gap, and you're getting a 1 hour shift in structure out of that. We're getting displacement, and we're seeing a bearish fair value gap, a SIBI. Then anytime it moves into premium of the range within a kill zone, you can look to short this, because we've identified that this is the drawn liquidity there. This looks like the sell side of the curve has started, because this is our smart money reversal, and now we can just short off of premium arrays. If we go into a 50-minute time frame, this is what I usually do. I go into the daily time frame. I wait for 1 hour to confirm that the move has started and we're in a buy program or a sell program, and then I wait for the 5 or 15 minute to retrace into discounted premium to short from. See, this is where turtle soups look really impressive, because you can set an entry above these highs and say, look, I souped this move. This is a turtle soup because I entered above the highs, right? But in essence, you're just really trading a fair value gap. So yes, this looks very impressive, but why does this work? First of all, we have shifted structure from the 1 hour time frame. Now, if we look at the 1 hour time frame on a 15-minute time frame, you can see that the range we created on a 1 hour, this is the shift in structure on the 1 hour, which is also shift in structure on a 15-minute, and this is our dealing range on the 1 hour and on the 15-minute, right? Because this is what buy side and this is what sell side is. This is a valid dealing range. We have buy side liquidity at equilibrium. So at the EQ of the range, there's engineered liquidity. So that's one confluence. And we are in premium of the range itself after we have confirmed a sell model has started. This is also a Tuesday. You can't see this, but this is a Tuesday. So we're expecting a classic sell week. Tuesday is the high of the week, so we can trust this is just a retracement into premium to then drop lower. You can either, with the knowledge you just gained here, you can either set a risk entry, which is just at the 1 hour fair value gap, sweeping the buy stops at equilibrium. That's a risk entry. Or you could wait for further displacement or confirmation that we are moving towards the sell side liquidity there. We're seeing one fair value gap here. You could enter off this fair value gap because we're seeing displacement, this fair value gap, and we just created a balanced price range here. You can set an entry right there with either your stop above here or, to be really sure, above there or something above this high, because this has rebalanced this fair value gap, so this shouldn't get broken. And right to move down. You can also get in at either retracement, because we can look at this. This is a original consolidation. On the 1 hour we are retracing, so this is even a smaller market maker model. This is probably a market maker model on the 3 minute in this move here. And this will be your low risk sell right there. And you see accumulation here. So this is probably your first stage of distribution, and this is your second stage of distribution right there. And you can see every order block is getting respected there. Every order block is getting respected there. So that's really nice to see. These are the potential entries you could have taken. So like I said, you can put your entry on this fair value gap. So we are at premium of the range. We are seeing displacement by form of balanced price range. We swept liquidity at equilibrium, and we're at a 1 hour premium array inside a daily premium array. And look at this as well. Look at this red line. This is converging with the 1 hour fair value gap. So we were just talking about the 1 hour. The 1 hour fair value gap is also nested within the premium low, or premium, yeah, it's a premium low, I believe, within the low point of this fair value gap there. So it's nested within that. So it's gonna give speed and displacement once it hits that, if we're truly bearish. That's what it does, and we move down. So this could have been a very conservative type of trade, because this happened on Tuesday. So if you expect Tuesday to be the high of the week, you essentially put your stop loss below your anticipated high of the week, and you just target whatever your target was, which is this original constellation. So this is a very conservative and defensive type of entry. For our risky boys, we could have also taken this, because we just seeing displacement out of a premium array within the premium of the range, and we swept liquidity. So if you want to go with this is fine as well. Here you can see the time as well. This is, I believe, within the end of London session, so that's even more confluence, because the end of London session usually means the high or low of the day has been set. And we can target these lows right there. And this is another example of a market maker sell model for GBPAUD. You have the original consolidation down here, and a first stage of accumulation right there. Smart money reversal, first stage of distribution, second stage of distribution. Okay, so where could the potential entries be right now? First of all, you have this breaker right there. So this could be a breaker entry. You put your entry at the breaker, or in this fair value gap, because this is in premium of this dealing range. Your stop above the smart money reversal, and you write it down. So this is your first entry, which is just a confirmation entry, because it's a breaker entry. You're waiting for confirmation, because we've seen the shift in market structure already. We're not selling above here. We're not waiting for limits to get tagged. We're waiting for confirmation that this is the move. Then your second entry could be here, because this is another breaker. Another structure point gets shifted here. So this is your second breaker within this bigger breaker. So this is a really high probability entry, especially if we form a short-term high with another high to the right, and we're expecting the short-term high to form, so this becomes an intermediate-term high. So if you have your stop above here and you're anticipating this short-term high to form here, this is a really, really, really good entry, because we are trading from a breaker within a bigger breaker. And this intermediate-term high formed in a fair value gap, and by definition any high or low that gets created by rebalancing a fair value gap also becomes an intermediate-term high. This is really a strong confirmation. We can enter the weekly fair value gap down there. This is a weekly fair value gap. You can't see this, but this is a weekly fair value gap, and it's the draw liquidity. So you can see how we are setting up an original consolidation. First stage, just like here, we break down. First stage of accumulation and second stage. This is the silver bullet, people call this. This delivers to the drawn liquidity really fast, as you can see, and we distribute it from this inverse fair value gap right there. So this one stays open, and this becomes a breakaway gap. Here another picture of the breaker right there. So this bigger breaker, this smaller breaker is within this bigger breaker, which is perfect. And these are the entries you could have gotten. You just have your entry here at the premium of the dealing range. Why are we not concerned with this fair value gap? Because it's in discount of this dealing range. So we're using this fair value gap, the upper one in premium, converging with this bigger breaker and this smaller breaker right there. And as you can see, if you extend this box, the bodies of these candles are staying inside this breaker, so this is perfectly valid. Then we break down, of course, in this from this breaker, so this could be another entry right there. You could even set your entry at the order block and you would have had even better RR. And even after this displacement down, you can you set your entry at this inverse value gap and write it down. These are all 2 RR plus moves. So these moves are all 2 RR plus. So that's really nice to see. Time frame for entries. As I said, I usually wait for a daily discount or premium rate to be hit. Then I wait for the 1 hour to switch structure and basically validate and confirm the move for the smart money reversal. So if I'm on a daily time frame, I wait for the discount rate to be hit. Then I wait for a shift in structure on the 1 hour. I look for the consolidation, original consolidation on the 1 hour to target later in the week. And then I just wait for the 1 hour to retrace into a premium or into a discount. And I do the exact same for the 5 minute. And I either trade off a 5 minute breaker then, or a 5 minute first or second stage of accumulation or distribution. And then I just target the 1 hour original consolidation, which is essentially a 5 minute original consolidation and as low hanging fruit, and the other one goes to the daily. You can also go straight from the daily into the 15-minute time frame. So if you wait for a daily PD rate to be hit, you go into a 15-minute time frame to scout your market, make a model there, and either trade off a breaker, etc. But I really prefer this because this assures that every time frame you're trading on is in a buy or sell program. Because if the daily is bullish and you're waiting for a retracement into discount, then you're waiting for the 1 hour to shift structure, and you're waiting for the 5 minute to shift structure. They're all basically in a buy program then. So daily's in the buy program, 1 hour shift structure, which is then in the buy program, confirming a smart money reversal. Then we wait for the 1 hour to retrace into a discount, and then we wait for the 5 minute to give us confirmation. So that's really the highest probability entry you can get, in my opinion. Same you can do for a weekly or a daily PD rate with the 4 hour. I don't like the 4 hour for a daily discounted premium rate, to be honest, because usually if you wait for a 4 hour shift in structure, you're already too late, you're already too close to the drawn liquidity, and that's where there's no risk to reward for you left anymore. So usually if we hit a weekly, I'll go for the 4 hour, and if we hit daily, I'll go for the 1 hour. So let's say we go with a weekly, daily, or premium array, then we hit 4 hour, wait for the shift in structure to confirm and validate that another buy program has started. Then you can either wait for the 15 minute or the 5 minute to show standard reaccumulation models or offset reaccumulation models. So yeah, that's really it. The essence of the video is just to show you what type of entry models they are. Obviously we just have the risk entry and the confirmation entry, and within the confirmation entry we have the breaker or the first or second stage. Yeah, and I really just explained you an entry model. Wait for the daily, the 1 hour, and the 5 minute to all be in a buy program, and once it retraces to a 5 minute discount, that's where you buy within a kill zone. That's a whole trading plan in itself. But yeah, thanks for watching, and yeah, like and subscribe, join our Discord, share it with your friends, and we hope to see you in the next video. Bye.